thank you all for joining us for this webinar. Imperial Advisory is sponsoring this, and we are a group of fractional CFOs. And as you know, in a large organization, a CFO is typically the leader's most valued and trusted advisor. What we attempt to do is to become that advisor for a company that's much smaller, that can't necessarily afford a full-time CFO, or perhaps needs an extra set of hands to do something in a financial advisory fashion. Our CFOs are, we all have 30 to 40 years, or most of us have 30 to 40 years of experience. We've owned companies, we've been CEOs, we've been in various size companies and followed several different disciplines in our careers. So with that, today's webinar is a conversation about improving cash flow. It's focused on manufacturing and distribution. And with that, I would like to introduce Buddy and Barry to take it away from here. Oh, actually, no, go to the next slide. I'll do the next slide, then you guys can take it away. So we're going to talk about 5 ways to improve cash flow today. And the areas in which we're going to focus are up on the screen. One area is inventory control. This one is, traditional inventory control has been to manage your inventory down, which is a good thing. But in today's environment, you may need to think a little bit about that because of the supply chain. But we're going to focus on keeping the right inventory in the right place. We're going to talk a little bit about net income versus cash flow. As I look at the people on the call, I'm sure you all understand why this is a focus for us. The impact of accounts receivable and accounts payable, and bringing down your net working capital is obviously a great way. A company can grow their way into having a cash flow shortage, and we're going to talk a little bit about that. Another way to improve cash flow, obviously, make more money, right? Improve profits. And then, of course, the benefit of using KPIs to keep all of these things under your watchful eye and to give you early warning signs. So with that, I will turn it over to Barry.
Next slide, Jennifer. I mean, one of the elements that we find very often, and I found for many of my clients, is that I'm making a nice net profit, but I'm running out of cash. And the truth is that, while net income is a very important element of generating cash flow, it's not the only one. That the cash flow is also affected by the changes in accounts receivable, accounts payable, inventory, and other current assets and current liabilities, what we normally call working capital, which is really current assets minus current liabilities. But we're not really interested in working capital. We're interested in cash. So we have to take into consideration all of the changes in working capital that are adjustments to net income to really determine the amount of cash we have in our business and how we manage to maximize cash. Jennifer, next slide.
Yeah, Barry, before you move on, can I just interject a story? Bob had mentioned that we all, except Gershon, have 30 to 40 years of experience. And I can tell you that in the 35 years that I've been either a CFO, COO, or CEO, 100% of the time, at some point in time during my tenure in that position, as the company grew from a baby company to a medium-sized company to an adolescent to a teenager to a young adult, the CEO and I have had a conversation that goes something like this. Here on this piece of paper you gave me, I made $250,000, but I only have $50,000 in my checking account. Where's my money?
Yep.
And so I think Lisa was a CFO or is wanting to continue to be a CFO. I would just say to all of you, that conversation is going to continue to happen because cash is the most complicated part of the financial side of a business.
Buddy, we used to have a spreadsheet that we sent around every day, and the heading on the spreadsheet was, "Where's the cash?"
In your business, Bob, and you ran that business for 25 years or so, where was the cash generally?
Most of it was in the machines. It was
In the
quarters
equipment?
inside the laundry equipment,
Oh.
and that's where it was.
Well, it's often in inventory, and it's often in accounts receivable. And the trick is, how do you manage them? And we'll get to that in a couple of seconds. Jennifer, next slide. I think the effect of the trade cycle or operating cycle on cash flow is a very important consideration. I had an acquaintance of mine who called me and said, my business is growing 30% a year. I'm very profitable, but I haven't got any cash. I'm running out of cash. I'm desperate. So I went into visited him for an afternoon, and it didn't take me more than a couple of hours to figure out what was going on. He was importing plastics, little balls of plastic that can be molded into products. And it's basically a commodity. So I don't think his margin was much more than 10 or 11%. I mean, you got the orders based upon price and service, but price was a very important issue. He was buying this stuff and paying for it on board the ship in Shanghai or Shenzhen or whatever else, wherever port in China it was coming from. And his bank was not financing his inventory. So he was doing it himself. And his billing was mainly to mostly major companies. His bank would reduce the amount of financing on his receivables after receivables were 60 days overdue. But most of his big clients were paying in 90 days. So here was a guy with a really relatively low margin who was basically financing his inventory and financing his customers. And on a lot of customers, he was actually losing money. From an accounting point of view, he was losing money. From a cash flow point of view, he was certainly losing money. So we went through and we decided that, as Buddy put in the next slide, that we're going to establish terms and enforce them. And if they're not going to pay, we're going to cut them off. So he told me he cut off 20% of his sales volume and his cash flow skyrocketed. And there's a lesson in that shows the relationship between cash and net income, or really the relationship that doesn't exist between cash and net income, and how it's influenced by things like receivables and inventory. That to me was a perfect example of the economics of a business that kind of went awry, and he didn't understand it. When he understood it, he was able to fix it. Next slide. And Buddy, you have anything to add?
Well, I think I wanted to go back to this concept of trade cycle. And I wanted to, so the trade cycle has become one of the most important definitions for me about managing cash. And what it does is it merges all of the metrics of working capital into one number that you can track. And so for everybody on this call, or for anybody who's not on this call, it is the sum of the amount of days of inventory you have, the number of days of receivables that you have, minus the amount of payables that your vendors give you as financing. And that number is a fixed number. You can calculate it as often or as little as you like. The lower that number is, as long as you're servicing the customers, the better. And so there's a legend about the origins of the Dell Computer Company. And for those of us who are old enough to remember when you ordered a product from Dell, you had to configure it on the website or on a form. They would tell you how much it cost. You had to pay for it. They would ship it to you when they felt like it, and then you would get your computer. The key to that is that you configured it and you paid for it. And then they would go out and buy the materials to make that computer, and then they would send it to you. They had what was then known as a negative trade cycle, because they had negative receivable days, or zero, and they had negative inventory days because they didn't buy inventory until they needed it. They got paid in advance, they bought inventory when they needed it, they paid for the inventory after they got your payment. Negative trade cycle.
Well, negative because their suppliers were so happy to supply them that they basically financed Dell.
Right. We did. Both the customer and the supplier financed Dell, and that's how they got to be Dell. And it's a brilliant business model from the perspective of cash flow. It's a perfect example of cash flow.
Here are some KPIs that we have found useful in managing accounts receivable, which is again one of the major components of our cash flow statements. And one of the common ones that's used is the aged accounts receivable. That takes your accounts receivable, shows you how much is in each bucket, 30 days, 60 days, 90 days overdue, and can help guide your credit department to go collect your receivables. And generally the banks, if they do accounts receivable financing, will generally cut down the financing on over 90 days. So to manage your cash, you've really got to make sure nothing goes to over 90 days. The day sales and accounts receivable is another measure of how good your collection department is and whether they're collecting or not. One I used that I found very interesting, I discovered that my credit department was calling their friends. And I said, how could I design a system that I could direct them to call who I need them to call to collect receivables? So I had my IT guys develop a system called average days to collect receivables. And we went back and looked at the history of every client we had, about 20,000 clients, and we had them calculate an average day it took each one of those clients to pay. And of course, what we did is we began to shorten that average. So and every morning we would print out a list for our credit department of who they had to call to collect, and we'd measure them against that. And it took no time at all for us to reduce our receivables by more than 30%. Huge effect on cash flow when we were borrowing hundreds of millions of dollars. And then again, the age payables, Billy, buddy, that's yours. I mean, you want to comment on that?
Well, we'll talk a little bit about that, but this is aged accounts receivable or accounts payable is a very effective way to create cash for your company. And there's some strategies around how you use that we're going to talk about a little bit later. But effectively, accounts payable are loans from your vendors, and they are free as long as you take advantage of the terms that your vendors are offering. So this is a way to create cash, accounts payable.
You know, if I could just interject for a second, and it wouldn't be me if I didn't bring up the people, but on the accounts receivable, a mistake that I've seen so often in companies is that you take your billing people and then make them make phone calls. And you need to look at the personalities of those people. Someone who is attracted to a back office accounting billing position may not be the best person to pick up the phone and ask for money. So just you know, when you're looking at clients, looking at your own company, just keep in mind that sometimes just reallocating personnel to get the right person making those phone calls can improve your success in reducing your overdue.
And sometimes the boss has to make the call. I mean, there are certainly times when the boss has to make the call.
Yeah, and the other challenge I used to face all the time was, you know, do you want your salespeople making those phone calls, right? Because the salespeople are often the advocate for the customer, and in some industries they're the right people, in some industries they're the wrong people. So you just got to be smart about making that decision.
Yeah, those decisions are relationship oriented, right? Who has the most positive relationship with the customer when they're in trouble? To sort of tag on to Barry's people call their friends. I think we talked about this the other day. In the middle to late 80s, I used to get an aging for our company that was, you know, thick like the Manhattan telephone directory. Green bar paper with every single customer, with every single line item, with every single invoice, debits and credits. And I used to ask the collections people to go through that and make notes on it. And then I would review the notes to make sure that they were making the calls that I wanted to make. One of the tragedies of that friendship that our people have when they're collecting money is that they sometimes make a note that's called working on.
Yeah.
And
or not available.
I used to get working on a lot. And finally, I said to this person who worked for me at the Chicago office, working on is not an answer. Working on means that someone, whether it's you or the other person, don't want to answer me. So please make that. So do not accept, if you are the person managing the collections department, do not accept working on as a reason. It's not.
Next slide.
So, I'm what they would call a fundamentalist, and I'm a fundamentalist not in the way that you might be thinking. I like the fundamental rules of business. And I said this to our team yesterday. When I took my first accounting class back in the 70s, I was very surprised in that first chapter that they said, if you want your money, make sure you get your invoices out on time. And so we were talking about the billing department, and we were talking about whether billing people are the right people for collections. The most important thing to do is the day that the order ships, get the invoice out. If you wait until tomorrow, or you only bill on Thursdays or something, that delays the amount of time that you get paid. So I always recommend to all of my clients and all the companies I've worked in, to go get those invoices out on time. Secondly, the payment terms that you define are your payment terms. They're not wishful thinking. So when you put in that little box, terms, those are your terms. So when Barry says, have your people call on those days and ask for your money, you have fulfilled your obligation by shipping the product and they're receiving it. So if you do not enforce your terms, if you sort of always accept that someone pays in 37 days and their terms are 30, they will always pay in 37. And then they might try to 38, and then they might try 39, and then they might try 40. So define your terms and enforce your terms. Barry, you look like you're ready.
I want to add something to that, enforce your terms. Sometimes they never pay. We entered a program. I was working for a very, very glitzy consumer electronics company. I was a CFO, and we entered a program with one of the most glitzy, famous department stores in the world. And we set up boutiques in all of their stores around the country. And we shipped them product to get it set up. And they must have owed us about $300,000. It wasn't a huge sum for us, but it was a significant sum. And we kept calling them and calling them and calling them, and they wouldn't pay us. So finally we lifted their franchise and we sent them a notice of seizure that we were going to pull back our merchandise. The next day, the chairman of the department store comes riding out to our office in his limousine and says, nobody cuts us off. And I said, you don't pay, you're cut off. And he was shocked. Well, delivered a check the next day. You have to really enforce your terms. Sometimes you have to take a chance. And you just, if you're going to, no, you don't give product away for nothing. It's too hard to generate. Make sure you get paid. I mean, when we did that with that department store, the sales guys went berserk, I will tell you. And we said, you know, it's not a sale until they pay for it.
Well, we have a sales guy on the call. But also,
love to hear from him.
Yeah, well, he'll tell you stories about how obnoxious I used to be. But this is at a different company, and I think I can say this out loud. I think Barry was very kind to the company that he was arguing with. But at the wholesale distribution company that I ran, our second largest customer was Kmart. And Kmart was notorious about being in trouble literally all the time. In fact, my first day at the company, I was required to solve a problem for Kmart. And we did, but at some point in time, they made me so angry that I cut them off and I asked them for their rebate back, and I did all those things. And the head of sales, who was my friend and pretty much my boss, said, I'm the voice of the customer. The customer is always right. Therefore, I am always right. And you can't cut them off. And I said, no, I'm cutting them off. They owe us $700,000 over 60 days. We can't afford it. You know, that's 5 containers of lunch boxes. We have to do this. Ultimately, you know what happens? They pay you because they don't get the set. that they need. As Barry was in the consumer electronics business, I was selling lunch boxes and coolers. There is literally no way that they can have an empty shelf in the cooler department. They can't replace your product. So stand tough.
You know, it also points out why some of the major retailers have gone out of business, that dealing with Walmart is very difficult from a pricing point of view, because they know how much your product costs to manufacture, and they will allow you X amount of margin, but they never take an illegal deduction. They never argue, and they pay on time. And that's one of the reasons why they're the biggest retailer in the world. Kmart, Sears, Toys R Us, they were impossible to deal with. They would steal everything, advertising, deductions. They were just impossible. And when it came the time they were in trouble, nobody in the industry wanted to support them. And that's that really, really happened. Enforce your terms. You don't give your stuff away. That's the lesson.
And by the way, we love this topic. So if anybody has a great story, now's a good time to tell it, because these are fun, especially the ones that end with a happy ending with you getting paid and keeping the customer. All right, Jennifer. So Barry, we're going to tag team on this one. Do you want to start?
Yeah, I mean, the other major element we've said of cash flow or impact on cash flow is how much inventory you have on board. Inventory ages, not everything sells. It's one of the most difficult areas to price, to manage, to forecast. But you have to be very, very careful. Your inventory doesn't get better with age. It deteriorates. Clear it out, get rid of it, turn it into cash. At least you're in anybody I know that's doing asset-based financing, they're getting a bigger advance on receivables than they're getting on inventory. So you're better off turning your inventory into a receivable and collecting some cash on it. I've learned from experience that make sure your first discount to get rid of something is your best discount. Because if it doesn't go the first time, it gets harder and harder after that. I've walked into a business my first day on the job, and my controller told me, he says, I can't make the payroll tomorrow. So I got all the staff, all the senior guys in the room, and I said, we have all this inventory. Go sell it. I need $250,000 sold by 5 o'clock tonight. Get on the phone. It's the only thing that's important. And by golly, they sold it. And we met our payroll. We actually had a cash balance. So it can be done. Buddy, take it. It's up to you.
I had this great experience. I brought in a young kid at my parts distribution company to do some IT work, and I said, "So we really need some help managing our inventory. We have to buy a lot because we're importing from overseas. You know, tell me what you know about inventory." And he said, "Well, my dad was a brake parts distributor in Fresno, and he had a warehouse. So when I was a kid, he wanted to teach me about inventory. So he took me out in the warehouse. He made a small box. He put $1 in it. He taped the box up. He put it on the shelf, and we forgot about it. But he didn't forget about it. A year later, he took me out in the warehouse, and he opened the box, and the $1 was still in there. And he said, that made an impact on me, and that's why I know about inventory today." So even though he was a computer guy, he understood the fundamentals of what inventory is. I had a very similar situation to Barry. I had a friend who was in the private equity business, and he bought a company that distributed some kind of stove parts or something like that. He said, or copier supply parts. He said, we bought this company and they seem to have a lot of inventory. And I'm wondering how long you think it will take to get rid of it, because you've now been in the distribution business for a while. And I literally, without even thinking about it, said, it's going to take twice as long and cost twice as much as you think it's going to take unless you deal with it right now. So Barry's advice was, I think that you said, make sure that your first cut is the most painful that you're willing to accept. Will you say that out loud for everybody?
I did say that out loud.
Say it for this group, because I don't think you said it for this team.
The first cut you make has to be the most painful, because it's the best chance you're going to have to sell anything.
And my personal experience having a distribution business with 250 million pieces in stock couldn't be more right. I had stuff, once we figured out how to age the inventory, it was stunning how many of those 250 million pieces were really not really inventory. They were just taking up space on a shelf. So be careful with your inventory. Bob, you got anything on that? Oh, Gershon.
Yeah, so I'm not officially a speaker today, but there's something I want to add. There's a fellow who we did a webinar with maybe a year and a half ago. He has since passed away. His name was Bill Schoolman, and he was an inventory guru. And one of the things that he mentioned on his we had a whole webinar on just inventory, and he spoke about the different kind of classifying the different parts of your inventory and looking at your A's, your B's, your C's. Look at the things. He says you might have some things which you sell a lot of, and yeah, you have too much inventory, but it'll work itself out in a month or two. And you have other things where you've got, you're selling one piece a month, you've got 40 years worth of inventory. Focus on getting rid of the C's, and you're going to take that painful cut like Barry and Buddy both mentioned, but think of the time value of the money and the fact that you would have otherwise not gotten paid forever. Whereas your A's, you'll sell out in 2 months. Don't focus on that just yet.
We used to sell about 280 different parts to Chamberlain to make garage door openers. And there were A's, B's, and C's, right? And what I used to say was, an A item, everybody in the company knows about. There's no chance that we're going to run out of an A item. But what can shut down a line is your smallest C item is just as important as the A item to keep in stock. But you just have to know how many you have to keep.
Did you, this is Colleen from Small Business USA. So did you guys, I'm sorry if I missed it, but did you talk about weeks of turn and weeks of sale on inventory? Like Gershon, when you talked about A, B, C, and D, kind of as you're managing this inventory, one of the most challenging pieces is keeping that week of sale number, always managing it as a business owner. So because when you don't always manage it, when you only wait till you need the cash flow or you need that influx, or your sales team needs to pop up and step up because you're in trouble, that's kind of feeds into this business challenge that you kind of have more issues than your inventory, right? And I think somebody in the box asked this question about, does this rule of inventory still apply? I think to Gershon's point with his A, B, C, D inventory level, like we always need to be on that, but now more than ever, because so many companies, manufacturers, distribution centers, they have this single point of failure, like what we saw in Malaysia, right? You have this single point of failure in your company, and that single point of failure may be related. Like if we go back to your Dell story, Dell could never get away with doing that in today's environment, right? And today we're looking at a single point of failure of one small little, computer chip. So I think every company, on top of, Gershon's point about this A, B, C, D for weeks of sales, you also need to take a very important look at your inventory for that single point of failure, which is something that I don't think we really talked about a couple years ago because we could always get it.
Let me point out something. There's a recall of a medical device in the United States by number one of the top 5 suppliers of this particular device. You cannot get a device in America. My doctor wrote a new prescription back in September. I'm still waiting for my new device because nobody factored in the effect of COVID, the effect of supply chain delays, of shipping delays. You cannot get this machine in America today. Nobody has them. And that's really a disaster. It's like the whole industry has basically collapsed.
Well, to get back to Nicholas's question,
yes,
this is about inventory and it's about services. The anecdote that I have on this is when I ran my company, the logistics teams were made up of very young people. And I used to say, it's great that you can call somebody and they're a broker and they're going to, have a truck show up in 5 minutes. But you ought to pick one giant vendor and buy 25% of the capacity that you need, just in case the broker can't show up. Just commit to some amount. And they basically said, old man, you don't know the way it is today. It's changed. So I said, okay, and you know what? But for the time that we had the company and they were running that department, they were right. I was wrong. Here's what happened. A year after I sold the company, I ran into the head of the logistics department who was working someplace else. I was selling a different product to him, and he pulled me aside and he goes, you know what? You were right. And I go, what are you talking about? I was right about a lot of stuff, but I was right about this. And he says, yeah, there's no trucking capacity today. And if I would have bought 25% of my capacity from somebody, at least I know that Conway, or whatever they're called today, is going to show up tomorrow. I call the broker today and they say, good luck. So the same thing is true about buying inventory. If you don't have a backup supplier, if you haven't reshored a little bit of something, you're going to find yourself in a world of hurt right now. Dynamics change, businesses change, times change.
I have a client who bought 3 years of computer chips before there was an issue. And
Wow.
Yeah. And he said everybody told me he was an idiot until he was a genius.
Yep.
There was a great article in the New York Times earlier this week about how Tesla managed to deal with the computer chip problem.
Yep.
They were buying off-the-shelf chips and writing their own code for them so that they could use them, and instead of designing very specific chips for very specific purposes. So they had a very, very long-term view of what that industry might do to them.
They were also very, very lucky.
You bet. You bet. Jennifer, next slide, please. Lose Jennifer.
Go ahead, buddy.
Oh, so this is what, oh shoot, who Colleen was talking about is, how do you determine this? Why is this important? So I have always known how many days or months, however you want to define your inventory is. And in the manufacturing and distribution business, I use days of inventory, how many days of inventory you have, because it makes doing your trade cycle easier. So some people like to know how many weeks they have on hand, but when it comes to inventory, I like to know how many days of inventory I have. Because the trade cycle is defined with the number of days of inventory, the number of days of receivable, and the amount of financing you get from AP. So in addition, Barry talked about knowing how old your inventory is. So in the business that I owned and ran, we managed our business by lot numbers. So once we were able to figure out how to turn that lot number into a date, we were able to age our inventory. And we're talking a little bit about financing and asset-based lending. Barry talked about when you age your inventory, a bank will only give you money on aged receivables, but they'll also do the same thing on inventory. So if you have inventory that's over, I don't know, Barry, a year old, would you guess?
No less than that.
Yeah, 9 months, they won't lend you $1 on that. And they're going to eliminate half of it for a bunch of reasons anyway. So the best way to manage your inventory is to know what's in there and make sure that it's moving.
I have a point to add here. When I was in the electronics business, we were the leading brand in the industry. And of course, what was happening is the dealers were advertising our product at cost. And you walked into the store and they said, you don't want to buy that, it blows up. It'll burn your house down. And we went into a very, very active legal campaign against dealers. But more important, we put together a seminar and trained our sales guys to teach our retailers that it wasn't just about margin. It was margin times turnover in buying from us. That maybe they made 10% less points on our product, but they could turn it over 4 times quicker than anybody else's, because we used to use we used to use Sanyo as the false prophet. And we'd say, you'd sell maybe their stuff twice a year. You sell ours 12 times a year. Every month you can turn it over. And we wrote a huge amount of business by teaching our dealers how to manage their inventory. And that's the other side of it, that sometimes if you're in trouble in your own inventory, teach your customers, get rid of how to manage to buy your stuff. You need the story. Stories work.
That's a really good example. That's a really good example. May we have the next slide, please? So accounts payable is a very interesting topic because you can take a bunch of different ways to deal with this. So if you are on the buying side and you believe this is a good source of financing, you have to negotiate your terms. You cannot just accept what the vendor is offering, and they will negotiate, but they will tailor, they will tailor their pricing and their service level to you based on the terms that you get. So if you're buying the standard package and they're offering you 2% 10 net 30, which I don't know if anybody does today, or credit card payments with a very, very small service fee, those are all negotiable because this is a way to finance your business. So if you're buying $100,000 worth of inventory and you get 30-day terms, you're getting $100,000 of free financing. There is another solution to this. If you are a credit card user or you are in love with credit card affinity programs, you can use your credit cards to get an extra 30 days or 40 days, however many days you get when you charge it on your card. Here's the wrinkle. Make sure that the credit card, that you don't pay any interest, because that defeats the purpose because they are the very high interest rates. And secondly, your vendors may charge you a service fee. I did a study for a customer or for a client just 2 weeks ago. They were using their American Express Platinum card for everything, and they had balances of $500,000 or $600,000. Their service charges by their vendors were over $70,000 a year. It's so much cheaper right now to go get bank financing to reduce that $70,000 to virtually nothing in the interest world that we live today, and still get your $700,000 in financing. Another way to manage your payables is to accept the terms that your vendor offers you and stretch them. So if your terms are net 30, you might pay in 35. You may pay in 37. You may pay in 40. But what happens in that is that you start moving down in the priority list of that vendor. So be very, very careful if you choose to stretch. The other side of that is, and I learned this way too late in my business life, is that if you pay early or you pay on time or you're consistent, to Barry's example of Walmart, if you're always consistent, you can move yourself to the top of the pile. And your vendors will be way more likely to do you a favor if you are paying them on time or a little bit early, or if they need something, you're able to provide it. I think Colleen had a quick question that might fit here. Go ahead, if you want.
Sorry, I didn't want to interrupt you because you're flowing so well there, buddy. We generally challenge our clients to go back and negotiate, but we're kind of at a standstill. We're seeing specifically in shipping, of course, but also because of inflation, we're seeing that companies just are not negotiating the way that they normally did. And I just don't know if, I'm dealing with a lot of smaller business owners with under 150 employees. So I'm not sure if, you guys have more success or have seen any influence because of that or change.
Well, I'm sitting in a place that is using that 70%, 75% of their COGS is sheet metal, 20 gauge, 22 gauge, 24 gauge, 16 gauge. There's literally no negotiation. If the distributor, Merit or Omni says this is the price on next Tuesday for your deliveries next Tuesday, that's the price. There's so many, I've seen so much with my client base in Arizona that there's no room for anybody right now.
Yeah, I haven't seen it at
I think
all.
that's true everywhere.
I'd like to
Yeah.
hear from any of the other clients that are on the call that maybe have some experience.
If anything, we're seeing like worse service, even like FedEx and UPS, where, you know, normally you could have, you know, we're having 10%, like as much as 10 to 15% non-deliverable with some of our product clients, which is awful, right? And then you go back and you ask, you know, okay, come on, let's negotiate the rate. If you're not going to deliver the product, or we're taking this loss, some of it is perishable. Let's have some conversation here. And there's nothing. If anything, there's price gouging on the other end of it.
See that too.
So I thought
see
maybe
that
there
too.
was some magic bullet you had there with this negotiating terms. I'm like, come on, this would have made this whole hour, that one answer could make this whole hour the best hour I've had all year.
Colleen, if you don't pay your sheet metal supplier, they're going to cut you off.
Yeah.
That is literally how it goes today. They are not going to say, oh, geez, you buy about $350,000 worth of sheet metal a week. We better make sure we ship you. They'll just ship it to somebody else.
Yeah.
Jennifer, do we have, oh, sorry.
Buddy,
I want to add one thing. Back to the credit card. So it doesn't directly solve, it doesn't solve the inflation issue, but we did another webinar we happen to have done probably about a year ago. We did with a company that designs custom credit card programs, and there's a lot more flexibility than you might otherwise know in how to set up a corporate credit card. And so they had ways that they could get you a tremendous amount of cash back if you paid very quickly, or get you, I think they said up to 60 days or maybe even longer terms with no rewards, but your reward is that you don't have to pay for 60 days. So that's definitely something that can help. And
So-
Let me
so
address one of the other issues
Oh.
that was just raised about the sheet metal. One of the things that I found in an area of high inflationary change was to place a forward purchase agreement, that if you buy ahead of time, you can lock in the price for at least some period of time. There are some tax issues with that, but generally, given what's going on now, I don't think anybody's going to bother anybody. But it takes having financial resources to do that. That basically, if you finance your distributor, you'll get better terms than anybody else. And if you place a purchase order with delivery X times a month, you can usually lock in a price, but you're going to pay for it.
Yeah,
Nothing's free.
I'm just going to remind everybody that if you go to the credit card strategy, it's a one-shot deal, right? You get that extra 30 days, or if you've got Gershon and you got somebody's program, you get 60 days. You get it once. So don't think you're a genius and spend all the money in the first 30 to 60 days, because you're not getting any more. So just remember, it's a one-shot deal.
but Buddy and Barry, if you could just make a quick comment on the other side of this. So if you're purchasing inventory, you know, the early payment discounts and how they calculate out in terms of ROIs, and alternatively giving those on the receivable side to help manage your cash flow. I wonder if you had any thoughts on that.
I never gave them as a big company. I had a lot of customers ask for it, but because I was so well financed, I didn't really want to give up that 36% effective rate of giving them a discount. You know, 2% 10 days is it's expensive when you don't need the money. As a buyer, I'd love to get it.
Right. So there's a guy on the call who I used to work with a long time ago, and our standard terms for our customers were 2%, 10, net 30. And at that point in time, we would just pray that they wouldn't take it. On the other side, once we got our financial house in order in the sort of mid 80s, we took every one of those 36% discounts that was offered to us. So that's the difference. And what you're finding today is that less and less vendors are offering those discounts because they're very, very expensive for them.
Yeah. So Marty put a comment in the chat. You need to develop great relationships with your customers and vendors to help you control your cash flow. I agree with that. And one of the culture issues that we used to foster in the organization was that our vendors were our partners, and and an extension to our customers. We're all really partners, and I agree 100% with what Marty's saying. To the extent that you foster those relationships, they help you through difficult times, whether it's a vendor or a customer. Great comment. Thank you.
Yeah, thank you, Marty. Jennifer, next slide, please. Okay, so this is me in a nutshell. Create a budget and manage to it. It'll help you a lot. And if you don't know how to create a
Hello, my friend.
What?
All right. Happy New Year to you too.
Oh, I think somebody's not muted. Okay, so so create a budget and manage to it. If you don't know how to create a forward balance sheet, because those are hard to do with days outstandings and increases in sales and working capital, that's what we're here for. So that is the most tricky part of building a budget, is creating that forward balance sheet and the resulting cash flow usage statement. I'm a big fan of key performance indicators. So know what you're managing to: days of sales outstanding, days of inventory, gross margin, operating income, EBITDA margin, whatever they are. Remember, they're just numbers. So if you don't know what they should be the first time, make something up, write down on a piece of paper, compare it to it. Our family friend, Peter Drucker, said, if you can't measure it, you can't manage it, or something like that. And then hold everyone accountable. There is someone in your company that is responsible for buying inventory or managing receivables or something. But if you don't hold people accountable, you are never going to generate positive cash flow. Okay, so the last thing is to make a profit. So our presentation today has been about small and medium-sized businesses that are relatively stable. These are strategies that you use when you have a business that's ongoing. If you're in a turnaround situation, or you've got problems due to the economy or something like that, these are not always the things that are going to help you. But making a profit in terms of creating cash flow is very underrated. So make sure you know what your margins are. Make sure that you're managing your expenses. Make sure that you know what your costs are, and think long term. Think, how am I going to get to the place where I'm always going to make money? Are there more? I think, Bob, you're back.
Yeah, I mean, just I think it's time to throw this out for Q&A. It's been interactive so far, which I really appreciate. I think it makes for a much better webinar. But